evening and welcome to New Money. I'm Bryan Hirsch, and this evening our program focuses on retirement and financial planning. The challenges for financial and wealth advisors is that clients often believe we possess such deep investment knowledge that we can predict market trends. The role of a financial advisor is to assess each investor's individual needs and to align their investments not only with their financial objectives, but equally important with their emotional comfort levels. While investment houses are required to send monthly and quarterly reports, these updates often end up creating unnecessary anxiety for investors. The word growth, which I'm now going to put up a slide, serves as a simple yet powerful summary of an effective tool. The word G stands for growth. You want to create growth, you need to take R, you need to take some risk. You want to create wealth, you need to have your investments, you need to hold them, and you need time. It's not timing of the market, but time in the market, and then you can see the O is you. That's how we create wealth for yourself. Everyone seeks instant gratification, but when it comes to financial advisors and long-term investing, it's unfortunate that many clients lose sight of their long-term strategy whenever their portfolio values experience short-term dips. And joining this evening is Daryl Bennett, Wealth Advisor of Sasfin Wealth, and Jordan Toy, Director of Legacy Family Wealth. Guys, good to have you on the program. The current media narrative about how highly valued the markets are focuses on the percentage of times the S&P 500 has risen versus the percentage of time it has declined. I've put up a slide, and I'm going to get Jordan to talk through the slide with us. The slide, if you can't see it, deals with 1, 5, 10 and 20-year returns. It talks about the number of times the markets are up and the number of times the market has been down. Jordan, talk us through the slide.
Thanks, Brian. So I think it's a very relevant sort of chart and to look at it where markets are currently, right? We're at a period where markets are touching all-time highs, which is fantastic. Obviously, investors across the board tend to be doing quite well. I think what naturally shifts into focus at times like this is, are valuations too high? Are we due a correction, et cetera, et cetera? And I think that's why I wanted to talk about the slide today, which is basically an argument of time in the market versus timing the market. So this is very much motivating staying invested for the long term, and what the chart is basically telling you is over short time periods, so 1 or 3 years or 5 years or 10 years even, there is a percentage of those periods where you might be down on your initial investment, right? But as you start looking over longer and longer and longer time periods, the probability of actually being in a negative position after 10 years of being invested, in this case in the S&P 500, decreases to just about zero. Obviously it's looking at certain periods in time, but I think the key takeaway from this kind of data-driven insights is that, you need to be invested in the long run. There will be natural cycles of ups and downs through markets, and there will be sort of bear markets as you go along this journey, but staying in for the long term shifts those probabilities more and more in your favor. It's not just a coin toss here. We're trying to take a longer term view and increase the likelihood of actually growing your money over time, as opposed to jumping in and out of markets. You could have invested just before Liberation Day, and then Trump comes out with a tweet and sort of tanks markets for the next 3 days or month or whatever it might be. So long-term investing is the key takeaway from that.
Daryl, you've always had the view of psychology, the psychology of investing, the psychology of the investor, the psychology of your clients. And it's quite alarming when they're getting information so readily, so quickly, which takes the mindset off long-term investing and puts more focus on short-term investing. So how do you identify with this?
Sure. Well, at a high-end level, the markets are driven at the one side of the spectrum from fear, and on the other side of the spectrum is greed. And in fact, there are indices that measure the fear-greed barometer and where it stands. And as we know, going forward every day, we're getting closer to the correction. We just don't know if it's going to happen in 5 minutes, in 5 days' time, in 5 months' time. So it's easy to try and intellectualize it, and it's easy to try and quantify it and show graphs. But at the end of the day, it's about staying the course. And I think what's important is if you've got a plan, you know why you've got a plan. What have you got a plan for? Is it a retirement plan? Do you have an investment plan linked to your retirement plan? Have you started saving young enough? Have you put enough money away? Have you given the plan enough time to work? And to sit with clients and say to them, listen, when the market does correct, it's a good thing. Okay, and just to sit tight and let it recover, and don't try and time the market, because markets always do recover. They don't go up in a straight line and they don't go down in a straight line. So I think it makes it a little bit easier if you've got a plan. If you don't have a plan, it can be very nerve-wracking.
But even people forget their plan. I mean, we live with that day in and day out, the plan. We understand the nature of markets. We understand that markets will have those bumps. I mean, as you say, Liberation Day. Last week was nearly another bump with Trump announcing. I mean, the man's delusional, because he does such good work on getting the peace in the Middle East, and at the same time he announces 100% tariffs on China.
Well, he's going to be here for 3.5 more years, so get used to
it.
No,
Daryl, not even 3.5 more years.
We're 4.5 more years.
No, we're into November. So 3 more years.
No, this is 3 years.
3 more years.
So he's around.
So I'm just wondering if a lot of the things he's doing now are going to be around. But I just want to talk a little bit about bear markets. And markets don't move upwards, you said. I'm going to put a slide which I'd like you to talk through, Daryl.
Right.
This just shows bear markets and you know exactly what has happened over the years. Because as you're saying, we have no idea when the market is going to have a correction. But we do know corrections come from 2 reasons. One, because of people's sentiment, and 2, people taking profits. And eventually, when people start to take profits, and traders have a major impact. But just talk through the slide, Daryl, which I'm going to put up now, about odds and experience bear markets increase by holding periods. Do you want to have a look at the slide?
No, well, it's similar to the other graph. I mean, the longer you're in the market, the more certainty you'll have of getting a positive outcome and getting positive results. But I think what's equally important, not only for clients to realize why you have to be in the market for lengthy periods of time, is because if you analyze the number of days where the market really rallies and gives you performance, it's only a handful of days. So if you look over a 10 or a 15 or 20-year period, you might find it's only the best 15 days of that 10-year period where you've actually got the growth. So that's why you have to be in the market for a long period of time. The bear market, listen, it all depends on your needs, and it all depends on what your money needs to do over and above inflation. Perhaps some people have got enough money and they don't need to be in the market. Or maybe they only need 20% in equities, and the balance in income funds and perhaps property or alternative investments. It all depends on your needs. It's an education for clients to understand how the different asset classes work. And as you said in your very first slide on growth, one has to take risk, a calculated risk, to give yourself a chance to get the growth.
Yeah. Look, you're always going to take corporate risk. No, sorry, market risk. You're never going to take corporate risk. But let me say this to you. There are a lot of commentators who are saying, and we hear this all the time, the market's at an all-time high. AI is maybe not coming through into the bottom line profits, and there are all other situations. And no one can tell when that's going to be. The point is, I come back to the situation, clients have a long-term view. You understand, because education empowers. So they understand the long-term. You've done all that evaluation, and then things go against. And this time, it's always going to be different. However, over the last 30, 40 years, we've only seen markets recover again after those short-term blips. As a matter of fact, we've had 3 very, very difficult times in the last 6 years, 5 years, which is very unusual. We had COVID, we had then the Russian invasion, and then we had the tariffs. All had some impact on markets in the short term. That's a lot quicker than maybe previous 30 years, where maybe there was a 5, 6 year, 7 year lag. But coming back to putting together a plan, I'm asked all the time, what is an estate plan, Jordan, and where do you begin?
It's a very vital part of your overall financial plan. I think you've both touched on it, the importance of that plan and seeing you through these different market cycles. The estate plan or document set is a key part of that plan, right? So it's a section that deals with what happens to your assets when you're ultimately not around. So I think at a very basic level, it starts with simply a register of your assets and liabilities so that your family or loved ones have an idea of what is where. And then from there, the next and most important component of that is likely your will. And then, from there you can look at different areas such as trust structuring if it's applicable to your situation. But I think it's a key part of the entire financial plan. We need to know that your beneficiaries liabilities are taken care of and that the process is going to be managed correctly. Obviously, if you pass away without a will, it goes through an intestate process, which can be very lengthy and can make it financially difficult for your family who don't necessarily have access to some of those assets.
Sean, particularly if you've got minor children.
Of course, yes.
Money ends up in the Guardian Fund. The Guardian Fund, they sell the assets, put it into cash.
So if I can just add to what Jordan's saying, so an estate plan is getting your affairs in order in the most tax efficient way. And what's important today is to make sure that you're working and collaborating with specialists in those particular fields. So I was dealing with a client who's got a local will and a local trust and an offshore will and an offshore trust. So one needs to work with those different specialists, the right specialist in that jurisdiction, the right specialist for the will in that jurisdiction, and then again the right specialist locally. The important thing then is to have a letter of wishes so that it's all congruent, so that the estate plan is congruent and it talks to the different entities so it all makes sense.
You know, you made the comment about your needs, but often, you said maybe you don't even need to be in the market because you've got enough assets and you don't need it. But you've also got to quantify what are your family needs, because a lot of the older people say, do I need to take risk? I'm never going to use this money. However, ultimately, their children are going to inherit. So you need to think a little bit further about what would their children want if you don't need that money, and what do your children want, thinking a little bit further ahead.
And where are the children living? Are they living in South Africa or offshore? What are they doing? Are they dependent? Are they not so dependent? Absolutely. That would tie into the structures that you set up.
Because Daryl, that's critical. Where are your children living? How are your children ultimately going to inherit? How are they going to get money out? Have they done financial immigration? What have they actually have they done to help them to access funds from South Africa?
And Bryan, I can tell you something with AI that is on our doorstep, and it's just the very beginning. You don't need to be a rocket scientist to know that governments will be talking to one another all over the world with all the different tax authorities because they're short on money, they need money. So it's very important to make sure your affairs are correct, are right, and make sense for the particular government or jurisdiction that you have got money housed in.
Okay, well, when we come back, there are two things I want to talk about. I want to talk about people's views on the rand, and I also want to talk about interest rates and how interest rates are impacting on decisions that are being made. We're going to take a short break. Stay tuned.